with the S&P 500. We're here to discuss that. My name's Dwight. If you don't follow me already, I'm with Defying Finance, and I'm not sure what platform you're watching this on or social media place. I am recording it through TradingView. It's a charting platform, so you might be viewing this on other social media. So make sure you like and comment on it. There's other people watching here. Maybe you could share your opinions with others as well. Also, watch an ad if it comes up. It's free content, doesn't cost you anything but a little bit of time. But anyway, let's take a look at this. I know there's a lot of stuff going on in the market, and to be honest, if you think about what's happening with Russia and Ukraine, the potential World War III situation, it's really tough to say what's ultimately going to happen in the markets. If you end up with a World War III situation, the markets are going to get wrecked. But that set aside, we were already heading into a crisis, and I believe we are heading into a recession, if not already in a recession. But I want to point something out here. I know I've talked about it in some of my other videos, and I know you're wondering what in the world is this yellow line here. Well, I want to show you something. I know I've talked about how the S&P 500, a lot of the stocks within it have been falling for quite some time. So I want to point this out. So you'd have a lot of stocks that have been cutting off around here. And again, the S&P 500 is weighted. So for example, Apple is 6% of the S&P 500. So you might have another company that's 0.50%, right? So if that stock moves, it doesn't quite move this up very much. But if Apple moves, it moves this up a lot more. So what you've seen is somewhere around this point, a lot of these stocks were actually collapsing, while a couple major weighted stocks in the S&P 500 kept this going up. That's why you cannot look at the price over here. You can't just take that and say, oh, look, the market's great. I mean, think about this. You're talking about 500 companies here. Let's say 50% of them were down 30%. Would you say the market's strong? Right? That doesn't make any sense. But if you see this line here going up, you're like, oh, look at this trend. This is amazing. The market's doing great, but that's not what's really happening. So you need to dig a little bit deeper just to figure some of the stuff out. But let me delete a couple of these items here. Now let me go back to about right around here. So this is the percentage of stocks above their 200-day moving average. So the moving average continues to grow or fall based on whatever day range you set. So if it's a 10-day, a 20-day, the typical ones you find with the stocks are a 50-day, 100-day, and a 200-day moving average. And when your stocks start to blow through a moving average line, so if you were to have your 200 moving averages here, your 100 moving average was here. If this is breaking your 100 moving average, generally you're looking for some sort of support on this 200-day moving average. So you're hoping your stock starts to trade back up in the right direction. But if we take a look at this kind of makes my point here. Right here, you can see that stocks were falling in the S&P 500. This was back in April of 2021, right? So everybody's saying, oh, look, the market's amazing. It's doing great. It's doing great. But a lot of these stocks were dying. So right here at this spot, something interesting. If you zoom out on this is a little unrealistic back here. So I got to touch that chart right there. So you can see all these major points here, here, and we could even put one here. Now you're talking about the 90% range. Right around here is 90% of stocks in the S&P 500 are above their 200-day moving average. Now you can see what happens. What correlates with that? Well, there's a big sell-off every time we get into this range at some point. Now you can see if we look at the time stamp down there, August 2009 to about April 2010. So there's some time that plays out between some of these tops, right? So it's not like it happens overnight. So they might ride that. So they get up to this 90% range and they ride it for a while and there's a little volatility and eventually they drop. So what we want to see is what are the percentages of the drops and these big spikes down, but we also want to look at, well, what's happening in that time, right? So the ones I want to focus on right now are 2008. Clearly, we know what happened in 2008, right? I want to focus on the 2018-19 era where the repo market was blowing up. We were going to head into recession at that point, but the government came in, buying up crap and just stalled this for a while. Then of course we know COVID, and even though this one's a little unrealistic because you're shutting down a world economy, right? I mean, that's probably equivalent to war. We're still going to take that one. So what I want to look at is, if we look at our highs here, market dropped around 57%. This is a weekly chart, right? Which is giving us a little more realistic, a little more stability. It probably dropped more than that if we showed on a daily chart, but let's use this. So we're going to take 57% there. Let's go to, now we're not going to use that one. We're going to 2018-19 zone. We had a drop of around 20%. So bear market kind of started there and then ripped right out of it because Fed got involved. And let's do, what do we got here? Let's do the 2021. 36%. So if we average those three out between 20% plus 37% plus 57%, divide that by 3, that's an average of 37%. So if we were to take that same type of crash, now we could see where these went, right? See down here? So big crash across the stock market, real estate and everything. Big crash right here. We were on our way to a big crash here. So we're going to look at these 2 points and we can see what happens. A lot of stocks get killed. They fall way below their support line of the 200-day moving average. So we would expect something like that to happen again if we're heading into a recession. So if this line is to come down somewhere in this range and have another 37% off the top, now it could be a lot bigger than that. Where would we fall is the question, right? Well, if we get down to this zone, we're at the beginning of this yellow bar I drew. Now, if we look where that lands, there is fair support beginning in this zone right here. Now that is an S&P 500 of 3,028. You can see my old lines here. Definitely, I think we're coming to this 37 range. And of course, this changes if the Fed gets involved. Remember, we got a lot of things coming against the market right here, right now. So the Fed's still raising interest rates, which they should raise interest. The interest rate should be a lot higher. That's causing a lot of these fake booms that we're having. They just need to get out of the way, but they're not going to, right? Politicians don't do that. They love to be involved in everything and think they control these markets. They buy votes with all this, garbage and printing of money, and it's just crazy. But ultimately, that causes inflation. So we're starting to see the effects of what happens when you print too much money and it finds its way back to your country here in the United States. So I would be watching something like this. How many of these? You can see right now, only 35% of the S&P 500 is above their 200-day moving average, right? So that's not a good sign. I think the S&P 500 will continue to sell off either over time, or we might have a couple big drops within a week or two, much bigger than what we've had. But I think that 37% from the highs is a very realistic level. So I'd be watching that. We could also bring up the relative strength index here, and let's see. Let's go look at, again, 2009. Look, we broke this line here. We broke this line in 2020. So I'd be watching for this to break this at some point. And it doesn't guarantee that this yellow is going to get down here. This one didn't look as bad because it was such a sharp fall over a short amount of time. But in 2008, I mean, you can see when we were kind of topping out here, the strength was dying at the beginning of 2007. So we could see this kind of trend its way. That's a weird line down into this zone. Maybe it breaks that. But you're talking about some time that has to play out to get there. So we'll see. But I do expect the S&P 500 to do this unless the Fed comes in to save today, prints trillions and trillions of dollars, create some sort of incentive to buy stocks, or if they subsidize something and it's going to work its way into the companies in the S&P 500. In dollar terms, you may see the stock rise, but that's when you have to start comparing it, and even earnings, right? You start to see bigger and bigger numbers and you think, oh my gosh, look, this company just made $1 trillion this year, some ridiculous number. But the reality is that number doesn't matter anymore, right? You want to know, what can I buy with it? Because when you see a chart like this with oil, right, you're thinking, yeah, what do I care if this company went up 7-8% this year when oil's up, ridiculous amount, or your food's up a ridiculous amount, or your rent's up. So really, if you were to value the S&P 500 in oil, is it crashing? Right? That's what you want to know. So I think I have one down here with gold. This is the Dow Jones. I don't have the S&P 500, but you could see here that even if the Dow at this time looks like it's going up, it could actually be crashing priced in other commodities that you actually use, or like gold, for example. I mean, it's used in the computer. I'm making this, the microphone that's going, your cameras, your computer screens, these cars. Same thing with silver, right? Silver's doing the same thing. Oil, just everything. Your chicken meat. I mean, is it crashing compared to a candy bar? If a candy bar was 5 cents before, is that candy bar really that much better? Right? How many candy bars did it take to buy the Dow back in 1960 compared to today? Right? That's the type of stuff you want to know. And then it tells you whether something is crashing, even though it looks like it's going up and to the right. That's what matters, because what you really care about, you don't care about the Dow Jones. You care about what you could buy with it if you sold it. What kind of car could you buy, or could you pay your rent if you were to sell that? That's what you care about. What do those dollars buy you? So anyway, keep that in mind. That has to do with ratios. So you could look at things like, I think out there there's a Dow oil ratio as well out there you could take a look at, Dow gold. But the S&P 500, I think, is obviously much better to compare things to, considering it's a much broader base market. You could also do this with real estate. So you can look at, go pick a downtime. I think in the area here, Sacramento, California is the area I'm in. I believe it was 90 ounces of gold or 92 ounces of gold to buy the median price family home in 2008 when it crashed. And I think it was upwards of 900 ounces of gold to buy it in 2006. I think it went up to 400,000 or something as the average price for your median family home, and it fell down to like 187. Now, when you look at that, the price collapse, you think, oh wow, it fell 60%, right? When you're just looking at the dollar value of those homes. But priced in gold, it fell 90%. That matters. So there's big swings in markets you can play with, all kinds of things like this. Like, for example, you see a ratio of your homes to gold, for example, going up. You know that, oh, look, it's a great time to buy a house here. And as it goes up, you decide, hey, man, this is getting really high compared to gold, right? And you can use this with other things too, but you start selling here and buying gold, the home price falls. That means your gold is actually going up, right, in value or in dollar terms, and then you go buy the homes. You basically long-term swing trade, stuff like that. So keep your eye on ratios, because in the future, I think we're going to be experiencing really, really heavy inflation. I mean, look at the money supply here, right? This is ridiculous. So this is what happens before you head into hyperinflation, right? You have this giant hockey stick that's building here. But anyway, this video can only be 15 minutes long and they kick me out. So again, make sure you like, comment, share. And if you like the free content here, watch an ad if it pops up. Have a good one.